Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York. It is Tuesday, June the 20th, 2017, and this is the Daily Report for Gold and Silver. Now for a second consecutive day this week, and in the third consecutive week of lower pricing, we have gold trading off about $2.70, $2.80, currently trading at $1,244 an ounce. The low today, which is critically important, we'll talk about that when we pull up our first technical studies, sits at $1,242.40 with a high today of $1,249 and change. Net change on the day losing about 0.2%. Silver also trading under pressure, but it is trading under more severe pressure, giving up about 0.5% on the day, trading roughly 8 cents lower at $16.42. Platinum is trading lower on the day, and the only precious metal to actually be showing a net positive gain is palladium, which is currently trading up about $14 on the day at $869. Traders, interesting action in gold today. And the action wasn't so much the price range or the amount that gold prices changed from the previous day, because we have a rather muted day in which we have a very narrowly defined range. What is significant to me today is where the low fell in regards to one of the technical studies that we look at. And I'm talking about our moving averages, specifically our 200-day moving average, which is this dashed blue line, and the 50-day moving average, which is this dashed white line. We know that we are in a declining price scenario that has been going on for now the third week. We're just entered the third week of lower pricing. We know that last week prices broke below the 50-day moving average. We also talked about the fact that yesterday prices came to a 61.8% retracement area, which comes in at 1246. Of course, that is a retracement from this last rally here, but it is today's low that is significant to me, in which we have the low pretty much match up precisely with the 200-day moving average. As I said, intraday low 1242.40 and 200-day moving average at 1242. So about 40 cents shy of that price point. However, the reason that is significant to me is that if in fact we have a scenario in which this market continues to trade in a bullish manner, and that bullish manner exists within periods of price ascent, and then that is followed by a period of correction, typically you do not see that correction go much wider than the 61.8% retracement area. We just broke below there, very subtly below there, but we are trading below there. However, the way that many market technicians define long-term trends in financial markets is the 200-day moving average. And this, therefore, becomes a very logical point to look for some sort of a potential bounce in the market and a return to rally mode. Now, that being said, as a market technician, I acknowledge the fact that it is real-time occurrences or events globally that move markets and not numbers on a graph. However, it has always been my belief that what technical studies do is they take that real-time data, the real-time events, and distill it or interpret it in terms of a numerical and mathematical quantity. And when we do that, it allows us to set a series of probabilities of outcomes of specific scenarios. In other words, just because we have reached the 200-day moving average certainly doesn't mean that we'll see a bounce and that the market will move above it. What it does say, however, is that if we have a continued decline in pricing and we get a break substantially below the 200-day moving average, that the bull rally and bull scenario that really has been in existence since the end of 2015, the beginning of 2016, when prices bottomed at 1040 and then moved up last year to about 1380, this year to 1300, that might in fact be coming to some sort of a conclusion. However, this is also a logical point to look for a potential upside bounce in gold prices. Therefore, traders, it is my recommendation that we maintain our neutral stance as we have a continued bearish outlook with no active or open trades, and at the same time, look for a potential bounce in this area. In other markets that we look at, a dollar is showing some slight gains today, trading up just under 0.2% at 97.41, but it is in the positive area. We cannot say the same for U.S. equities, which are in fact trading lower across the board. Dow Jones Industrial Average 21,467, putting it off about 61 points on the day, or losing 0.3%. Standard & Poor's also under pressure, but almost a 0.7% drawdown at 2437. And then lastly, the NASDAQ Composite Index is down about 0.8% at 6188. Whether or not U.S. equities have hit some sort of a potential top as recently as yesterday, when we saw this market move to new all-time record highs in the Dow and the Standard & Poor's, or if this is simply an area of consolidation and sideways trading as we've gotten on so many instances just prior to a big move, is uncertain. What we can say is that the market has definitely given back a portion of the substantial gains we have seen occur yesterday, and we might in fact get these gaps that exist not only in the Dow Jones Industrial Average, but also in the Standard & Poor's chart. Let's go ahead and pull that up. This gap here, if these gaps will actually get filled, because as a market technician, we always look for any kind of price void or gap in the market to inevitably get filled by price action. And traders, lastly, I do want to look at crude oil. Crude oil under incredible pressure, really now in its fifth consecutive week of lower pricing after trading to about $52 per barrel. That was the high that was achieved after coming off of these lows just at around $44. We have now broken below that price point. That is significant because that sits at around a 38% retracement, and that of course is a retracement from these lows that were achieved back in February of 2016 when crude oil drifted all the way down to $26 per barrel and then moved to $56. Our target right now for crude oil is a continuation in price decline, taking crude oil prices to roughly $41 a barrel. That is a 50% retracement of this long haul from these lows at 26 to $56 per barrel. Traders, as we talked about during the technical studies portion of the show today, what a market technician does in essence is distill real-time events into a quantifiable number, mathematical formulas or quantifiable numbers, which allow us to extract degrees of probability of a specific occurrence in the market. That is why we believe that although there is nothing right now in terms of real-time events that would cause gold to spike higher, this is an area that warrants our attention. First, we're at a 61.8% retracement of the most recent rally. We have broken below the shorter-term 50-day moving average, but the intraday low today fell precisely to the 200-day moving average, and this would be a typical place to look for some sort of upside bounce. We will have to see how gold prices unfold over the remainder of the week going into next week, but as I said, although we have no concrete event evidence that would display a rationale for gold prices to stop this free fall and begin to track higher, this is a very logical point for us to watch and look for that possibility. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.